Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for June 28th, 2022. I'm Ken Animo, Chief of Analytics here at DAT. We have a special guest today. We have Dr. Inam Ayub, who heads up our data operations team here at DAT, and the rock of the podcast, we have Dean Croak, who's our principal industry analyst. Good morning, guys.
Good morning. Welcome, Inam. Good to have you with us.
Same here.
So Dean went for resort wear. I clearly lost an altercation with the swimming pool in Florida. Inam seems to be the only one here not worse for wear.
Yeah, I had to get some of my Father's Day kit out to wear it while it's warm.
Well, we have a lot going on, so we're going to hop into it here pretty shortly. But please feel free to drop your questions. We have a marketing team that feeds them over to us on LinkedIn, YouTube, or Facebook. We'll be happy to answer those live at the end. But with that, since we have so much to cover, I'm going to jump into our key points of the week. So spot rates flat for all modes ahead of July 4th. So this is typically one of the busiest weeks of the entire freight calendar. You've got end of month, end of quarter, end of the first half of the year, and the holiday week coming up. We've got produce volumes down, lower than June 2019, heading into this peak week. Spot market load posts, same as 2018, but the highest in 6 years for equipment posts. Contract rates entering the routing guides are up about a point, but rate of increase is slowing. The ton-mile index coming out of Michigan State is up 2.4% year over year. May ATA tonnage up 3.7%. Again, hard to find those numbers recessionary. And then the AB5 injunction could stay in place. We didn't see anything come out yesterday, but we'll continue to watch it closely this week. So with that, I'm going to turn it over to Dean to walk through our market update. Dean?
Thanks, Ken. Let's start off with the dry van load to truck ratio. Load post volumes were up about 5% last week, still 10% lower than this time in 2018 and about 32% lower than this time last year. As Ken mentioned, equipment post volumes in the DAT freight network are running around 17% higher than this time last year. And as a measure of how oversupplied the dry van market is, equipment posts are at their highest level in the previous 6 years for the middle of June, which is unusual. Load to truck ratio last week ended at 3.75. In the refrigerated category, long haul produce volumes are down 16% year over year, which was 19. That's compared to 19, which was the last typical produce season outside of the prior two pandemic-driven seasons. That's important because that's the equivalent of 28,000 fewer weekly truckloads of fruit and vegetables moving last week compared to 2 years ago. So as a result, load post volumes are down in the reefer sector, but they're on track to maybe be around where they were this time last year, depending on how good this week goes. As Ken mentioned, a lot of activity this week. Load to truck ratio ended last week at about 7.65. In flatbed, load post volumes have dropped about 40% in the last month, now 26% lower than the prior year, but tracking 2018, as you can see from the chart. Equipment posts are also at the highest level they've been in 6 years, about 15% higher than this time last year. Ended last week at 33.68, higher than 2018 and about the same as 2017. In the market condition index, a quick look at some of the markets today. Load post volumes in DAT's number 3 and 4 largest freight markets, Los Angeles and Ontario, they've been relatively flat for the previous 3 weeks. Capacity continues to tighten, though. Rates have been going up very slowly for the third week in a row now at 229. The average outbound rate from those two large markets is up 6 cents a mile over the last 3 weeks. On the long haul lane east to Chicago, rates are 78 cents per mile lower at an outbound average of only $1.76 this week, but it is 12 cents a mile higher than the May average. So capacity is tightening slightly there. In DAT's number 1 dry van spot market, Atlanta, it's got about a 4% market share. Volumes increased last week. Capacity continues to loosen in East Coast markets. Spot rates in Atlanta dropped for the 4th week in a row to an average of $2.12. Some lanes, they were a little bit better. Capacity tightened on the high volume lane from Atlanta to Orlando. Spot rates on that lane are averaging $3.12 a mile. That's excluding fuel. Up 18 cents a mile on the May average, but only 31 cents per mile lower year over year. So pretty good rates for carriers on that particular lane. Elizabeth, New Jersey, capacity continues to loosen. It's our number 7 market. Spot rates dropped 10 cents a mile in the last month to an average of $1.65. Elizabeth to Atlanta loads are paying even less at $1.43. Loads to Dallas are even lower out of Elizabeth at $1.36. Having a look at the refrigerated market, Atlanta's our number 1 market again, with more than 85.5 million people within a day's drive of Atlanta. It's no surprise to see a lot of freight market activity there ahead of this weekend's celebrations. After being flat for most of June, load post volumes jumped 14% last week. Capacity continues to loosen though. Rates dropped in that market 3 cents a mile to an average outbound of $2.47. Atlanta to Orlando, capacity tightened just like it did in dry van. Rates were up to $3.09. That's about 60 cents a mile lower than the prior year though. On the southern border, capacity tightened following last week's 7 cents per mile increase to an average of $2.40, but we're well past peak season imports of produce from Mexico. So as a result, we're seeing spot rates on some of the more popular long-haul lanes start to drop. Laredo to Hunts Point, New York, down 20 cents a mile in the last month to an average of $2.32. That's about 84 cents a mile lower than this time last year. One of the other major loans for reefer carriers is Fresno to Hunts Point. At $2.14 a mile, reefer line haul rates on this lane are 5 cents per mile lower than the May monthly average. Again, that's against trend, and just over $1.30 a mile lower than this time last year. Capacity has also been flat for the previous 3 weeks on the Fresno to Chicago lane, averaging $2.06. It's exactly $1 a mile lower than this time last year. In the Pacific Northwest, load post volumes have started to heat up. The long sort of rate slide that's been going on in the Pendleton market has been corrected last week. Rates only went up by a penny a mile to an average of $1.71. But there is some signs that market is starting to turn as a result of the upcoming produce season in the Pacific Northwest. In the flatbed market, one of the markets that was pretty hot this week was our number 1 market in Decatur, Alabama. Load post volumes were up 23%. But capacity loosened slightly. Rates dropped 3 cents a mile to an average outbound of $3.80. Decatur to Kansas City, about 800 miles. Rates increased last week to $2.90, still 20 cents per mile lower than this time last year. Next door in the big distribution market, logistics market of Memphis, capacity loosened also. Rates dropped 9 cents a mile to an average of $3.43. Loads moved between Memphis and Dallas. They were up 4% last week, but line haul rates decreased. Still plenty of capacity there at $3.50 per mile. That's 30 cents per mile lower than the May monthly average and about 22 cents a mile lower than this time last year. Houston came in at number 4 this week in terms of load post volumes. They've been pretty flat for the last 3 weeks. Line haul rates have been holding steady at $2.94. Having a look at our year-over-year spot rate summary, dry van line haul rates on our top 50 lanes, as measured by loads moved over 250 miles, they averaged $2.36 per mile last week. That's about 40 cents per mile higher than last week's national average for all of our lanes at $1.96. The national average dry van rate, it increased by less than a penny a mile, so essentially flat. It's still 40 cents a mile lower than this time last year and 10 cents a mile lower than 2018. Dry van rates excluding fuel are down about 29% year to date, but still 26 cents per mile higher than the average of pre-pandemic years. A similar story in flatbed. Rates were flat, increased by less than a penny a mile. It is the second successive week of very small gains in the refrigerated market. It's very unusual for that kind of increase. Normally it's a lot more in non-pandemic years. Reefer line haul rates typically increase by 12 cents per mile in the first 3 weeks of June. This year, they've dropped by the same amount month to date. We could see that reverse this week, though, but certainly against trend at the moment. At $2.26 a mile, reefer line haul rates are down 28% year to date and down about 9 cents per mile month over month. Currently 51 cents a mile lower than this time last year, but 23 cents a mile higher than the average for pre-pandemic years. And wrapping up our market update with flatbed, rates were also flat last week at $2.58 a mile, slightly below the 13-month average. They've been pretty consistent around this level. They've only decreased by 3% year to date and are now 16 cents per mile lower than this time last year and about 11 cents per mile higher than this time in 2018. And compared to non-pandemic years, flatbed line haul rates are currently 53 cents per mile higher. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update. and download our weekly report, which will be published on Wednesday evening. With that, it's over to Ken for the short-term forecasts.
All right, frying pan to the fire here. Go from vacation to covering for Ned. So looking at national dry van spot rates, short-term forecast. So the blue line are actuals, long haul only. So that's a rolling 7-day rate per mile. The green line is rate cast. The red line is our short-term forecast. And then the two, the yellow and the gray, are blends of both in different mixtures. So as you can see, rates have been falling in the spot market, but they've been pretty flat over the last month or so. That last dip that you see is largely related to when fuel was up 15 or 16 cents. Perhaps once the government gets off their MS-DOS operating system and actually tells us what fuel is going for, we'll know what the updated fuel surcharge is. But as we wait for that, we're essentially in a holding pattern, it seems. Ratecast is predicting the typical seasonal run up to the 4th of July over the next few days, and then things to slow down after. Things do get pretty slow. If you look at the long-term forecast, it'll show that things get really slow between 4th of July and back to school. So it's a month and a half of pretty slow activity in the dry van market. Let's go to reefer real quick. Again, same chart. Blue's actual. Everything else is a forecast. We've seen a little bit of positive lift in reefers nationally over the past week or two. All the forecast models pretty much agree that's going to continue, and then they all pretty much agree that it's going to slow down after the 4th. There's probably a little bit of a longer hangover there post 4th of July, perhaps through the balance of that week into the next week before things slow down. This one's the most interesting to me, moving on to flatbed. The model's picking up both short and long term, which obviously we're not showing long term here, but it's picking up on some pessimism in the flatbed market. If I had a hunch, I would say that's largely based on some of the slowdown we've seen in some of the leading indicators in the housing market, higher interest rates, cost of raw materials and supply chain shortages are still up. So long-term oil and energy prices may be coming down a bit too. So you got some deflationary pressure here on flatbed, which will be important to watch because all 4 forecast lines here are showing softness over the next 35 days. So with that, I'll turn it over to Dean for our question of the week.
Yeah, this is a bit of a segue into our guest today with Inam. What we'd like to do is hear about how the market is turning into a shipper's market. So, Inam, what are ways shippers will know the market is shifting?
Yeah, I think that's a good question. First and foremost, of course, with market updates like this, right, you're giving a national view of what's happening in the market. The second aspect of it is you will see in your own network, your rate per miles will start either stabilizing or starting to drop, especially if you can break your rate per mile by spot versus contract. Another side of it is you will see your acceptance ratios climbing, right? I mean, we know that end of last year, or Q3, Q4 last year, the acceptance ratios were in somewhere between 75 to 80%. That's what the contract rates were getting accepted at. Now you will see, in the mid 80s. Generally, shippers, the best case scenario, they like to be in low 90s, but now you will see them in the mid 80s and climbing. So those are clear ways that you will recognize that the market is shifting, and also the carriers will start calling in, right? That is a clear indicator that the carriers would want to keep the volumes that they're currently moving, and they will start talking about potential rate reductions to keep those volume at times like this. So those are clear ways that you will know that the market is done.
As a shipper, right?
Yes.
So as a carrier, subject to the spot market, I'll flip that question over to Dean. How do you kind of suss out that it's kind of turning to a shipper's market as a carrier?
One of the best places is truck stops. It's not a technical data point, but when you start to see a lot of trucks parked in truck stops, a lot of trailers empty, A lot of people, deadheading in the opposite direction when they'd normally be loaded. There's some really interesting tells in the market when the market's softening, notwithstanding the fact that rates are decreasing. When spot rates start to decrease, that's of course a giveaway. But there's some leading indicators that are ahead of that you can see all around you every single day, mostly in the truck stops in particular.
Right. And to be clear, right, what we're talking about here is your typical market cycle. Right. The Pickett line or the Coyote curve or the DAT truckload volume index are the things that kind of follow that sine curve of the market goes up, market goes down, market goes up, market goes down. That's what we're talking about here. We're not talking about some black swan event. Right.
And this kind of leads into the shipper world, because one of the major bugbears of carriers in particular, both contract and spot, is dwell time on loading docks. And there's a definite relationship. When capacity loosens, dwell time goes up because shippers have a less of an interest in, keeping hold of that capacity. When capacity is tight, everyone's interested in getting trucks off docks quickly and showing drivers all the love they can. It's quite the opposite when capacity loosens. So that's another indicator. But what are shippers doing in that regard? Because you mentioned it's turning into a shippers market. So what does that mean for carriers that in both the contract and spot market? But in the contract market, what does it mean for RFPs? We've heard comments like the annual RFP is dead, and people are doing more mini bids. Is that the case, or is it more of a mix?
I think to your earlier question, shippers in last year's market, I think more shippers wisened up that they are focused. It's a strategic move on their side to be a shipper of choice, right? So the shipper of choice is a serious issue for them, and they are working closely to keep up with the dwell times, keep the carriers happy, keep restrooms, break areas, and so forth. So I think it is very clear the shippers are very serious about that. To your second question about RFPs, the consistent high volume lanes will hold the annual or every other year RFPs. It is interesting for both parties, carriers as well as shippers. Carriers don't want to get jerked around every so often, right? And they can build other networks around it. So they can depend on the freight and they can build other networks around it. The same happens from a shipper's perspective. They don't want to see churn. There is a cost associated with the churn, and so forth. So for both parties, they don't want to keep shifting this in a very short term. The mini bids were done because of necessity. Freight was falling off the routing guide. They were paying 35-40% above market whenever it goes to the spot market. So they were conducting mini bids to take them under control. It was still coming at a premium, but it's not as it was going to the spot market. So what we'd see in the coming months is that whatever the annual bids that are already set, whose contracts are running out, they will conduct their bids to get those rates confirmed. However, shippers are also evaluating the lanes that they are severely paying above market, right? I mean, coming from last year, there are certain lanes that are severely above market. Those lanes they would isolate and put out in a mini bid to get them in line with the market.
Gotcha.
I also hear from the shippers that they in the way the rates were increasing last year, they already had a understanding with the shippers, even when they did the RFPs last year, that if the rates shift one way or the other, that on a quarterly basis they will discuss rates, meaning they will modify rates accordingly.
Right.
So even if the carriers don't get churned out of the routing guide, they will still have a conversation about modifying the rates, especially in today's market, reducing the rates. Now, how do they reduce that rate, or how do they change that rate one way or the other? I think in the last cycle, it became very clear to have a clear third-party index, right? I think that's where the DAT index comes in place. that many of them are using the DAT index because again, the reason I emphasize on the fact of third party without any, dog in the fight is, so it is very clear to them. We present what exactly is, and they're using that index to adjust the rate based on the market changes.
Got it.
Yeah, I think the best advice I could give, and I'm guilty of this on the other side of it, is don't subscribe to absolutes in the freight market, right? The RFP, like Chris Kaplis, I think one of those cheeky comments in the last couple of years is the RFP is dead. Long live the RFP, right? He had a whole tranche of content around that. It's like there's still going to be firms operating under the old paradigm, and as soon as things change from a Six Sigma event such as COVID, people are going to go back to what's worked for 30 to 40 plus years, right? Why wouldn't they? And sure, there might be some lasting vestiges of what may have worked for some. I sat on a panel with a very interesting shipper that had to deal with the front end of their supply chain was perishable, and then coming out the other end was shelf stable. So they basically said they're never going to go back to long-term bids. They're going to stay with. They were doing bi-weekly bids during COVID. They'd love to get away from that, but perhaps monthly rebids on the perishable side, and then long-term contracts on the shelf stable side, right? I mean, so supply chains are very, very diverse, and it's hard to find an absolute in this market.
Yeah, I think you're absolutely right. I think the takeaway from especially last year is shippers have to really understand their freight network and take a portfolio approach, right? So when the capacity was very tight, dedicated private fleets were becoming, very attractive, right? So where do you use them? What is the right size for that? When do you take advantage of it? Because you're going to pay regardless whether you use it or not. Then comes the committed capacity on the over the road side. But also, I think the how people saw the spot and how they're executing in the spot market also changed with the whole dynamic API pricing kind of approach, right? Back in the day, when we did procurement events, RFPs, we put everything in the bid, right? I mean, we rolled up all the infrequent freight into the bid and tried to get a contract rate for that. Many sophisticated shippers are now backing off of that. They're looking for low volume, infrequent freight, and they are separating out. That they clearly understand this is not going to hold in a contract market, and they are separating out and taking advantage of all the new technologies out there for spot price and comparison of spot price.
Yeah, I mean, kind of moving a little bit beyond procedure. If you're a shipper, this talk of, so take like the politics, like even like our little industry politics out of it. I mean, they're not experiencing any real rate relief at the moment. I mean, they are facing the full brunt of the fuel surcharge program that they have in place. Their contract rates are as high as they've ever been, right? And they're not as reliant on the spot market, which has come down a bit, but all the numbers we report are net fuel. So when you add fuel back into a lot of these charts we're showing, it's not that much relief over where we were at the peak. So if you're this is what makes this market really, really, really unique. We had these internal discussions trying to find a proxy period. So it was 15, 16 when the market really, really slowed down, like an industrial driven freight recession. Supply and demand dynamics kind of moved in concert to what you would expect. 2018, the huge influx of capacity in the tail half of the year drove the market down and caused a very slow 19. But this year, shippers are paying more, carriers are making less. Like, that's an interesting equation to try to solve for, right? So I don't know. I mean, there's a lot that's going to be written and researched once this thing's in the rearview mirror of how do you anticipate a market where exogenous cost, right? So because the price of fuel has nothing to do with the freight market by and large, right? And yet it's arguably the single most important driving factor right now for shippers, brokers, and carriers.
In any sense that there's the market's peaking in terms of the direction of contract rates?
Yes, the contract rates have already. I mean, we for almost 4 to 6 weeks in a row, we are seeing that the rates are not increasing. It's flattening,
Right.
just bouncing around a little bit, but it's not increasing. Anecdotally, we are hearing the shippers are hearing from the carriers for rate reductions. All the points that we talked about, soft points as well as from a data perspective, all signs are that the contract rates are already peaked.
Got it.
Which, so kind of our foundational thesis is Q1 things start to trend back up next year. That seems to be in line with what we would expect. I mean, contract rates need to plateau and perhaps contract a little bit for the market to get back into the groove that it needs to find. Ocean shipping, we should have someone on, Dean, if we can get someone on, talk ocean shipping, because that's really going to be, as freight gets boring here from mid-July to late August,
Right.
it might be interesting to talk to someone on the ocean side, because that's when a lot of the retail stuff's coming across that will be stocked up for the fall.
Got it.
It'll be interesting, right, with the inventory. There's a lot of debate out there about inventories and consumer sentiment and inflation right now. Be interesting to see how that all comes together and intersects this fall.
I think what's also interesting, Ken, is that we saw this last year, even without the surge in inventory, that we saw Black Friday in July and August, right? So it's already with the surge in inventory, we are already starting to hear that, and pulling the demand up. So I think with all the freight blocked in China and coming on its way now, and how the retailers are going to flatten that peak demands, I think is going to be very interesting.
There was a interesting article on NBC yesterday in Macy's, Target, Walmart, and other big retailers said inventory levels in the first quarter are up anywhere between 17 and 45% year over year. The more interesting statement was from the CEO and president of Walmart, where he said there's probably 20% of inventory. If you could just wish it away and make it disappear, you would.
I'll take it.
Wow.
Exactly.
I mean, I think some of these things are, I mean, I don't know. I think day trading the freight market is a very bad profession to be in. I mean, I think value, like if you had to equate it to stock investing, I think value investing in freight is probably the way to go. Looking at large shippers and large publicly traded trucking companies and what they're telling the street is probably not perhaps the best source of information. Keeping in mind they have the sole motivation of their stock price going up. I mean, we'll see. In the roundtables, I'm used to sitting every one of them. I mean, there's still a lot of concern around having the right inventory this fall, right? So inventory levels aside, there's still a lot of concern about having the right stuff on the shelf this fall.
Yep.
Absolutely. I think we know that there are a few events that are coming very time specific. Last time, the whole Halloween, we completely missed.
Yeah. My mom works at Walgreens, like part-time, is retired. And yeah, she got Halloween decorations in November. They were getting Christmas stuff in February. So hopefully it won't be that bad this year, but there's still, I think, a lot of apprehension. And there's probably, my guess would be, and again, this is way, way, way into tinfoil hat territory, that the procurement managers, the supply chain folks perhaps know a little bit more about the situation than the CEO in this instance, and are deliberately building inventories heading into the fall. Might be one approach that they're taking. CEO doesn't want to see that inventory on the books, right? Because it's a huge carrying cost. It's a ding against working capital. But I think a lot of the procurement and retail side folks might know that those things are going to be really hard to get in August and September to get them on the shelf for Black Friday. But that's just total tinfoil hat conspiracy thing. What do I know? I think everyone started to run to the grocery store to buy their hot dogs early because we're not getting very many questions.
Right.
I don't see anything across any of our 3 platforms, really.
Okay. There's one.
Peter Austin. Are there any place I can go to see what percentage of authority is closed?
The only place I know, Peter, is the FMCSA census file, and that's a monthly data feed you can get, but be careful with that because it doesn't list, as far as I know, the class size of the truck. So it'll include everything over 10,000 pounds GBW, which will include a hotshot truck with a dually and a trailer, right up to a Class 8 sleeper trailer.
Garbage trucks, school buses,
everything in that number. Yeah.
I mean, I know there was like a bunch of buzz around that bar chart that came out with the carrier revocations, but I mean, keep in mind, the chart was good because it accurately footnoted that the government was clearing through a clerical backlog that they were facing. Again, the FMCSA data is extraordinary. Take it from a company that knows, right? We sell a product that sits on top of the FMCSA data and reports it out to our customers. That data is extraordinarily messy and hard to disentangle. Who knew the government would have a hard time with providing data? I'm just really wanting to get my hands on a fuel number, right? Because based on indications I'm seeing, right, fuel should come down the next time they actually report on it. Is that what you're seeing, Dean, or is that shifted a bit?
I think it's shifted a little bit, Ken. I think people have gotten used to this situation right now.
I should ask the question a different way. Do you expect fuel to come down when the FMCSA finally reports on it?
Yeah, I think that's the expectation. But heck, it's gone up when we thought it would go down and vice versa. But I think in the last 2 weeks, there's been some positive signs that it should come down when they announce it today.
They're going to announce it today?
Well, again, I think that's what's going to happen, but I could be wrong on that. That's the
I was kind of anticipating waiting until next Tuesday. Because they won't announce it Monday night because of the holiday, so they might.
Yeah. Well, they've been collecting the data, so they can publish it. I'm just not sure when they'll do that.
Yeah, I'm sure they've been collecting it. The carrier pigeons came home to roost.
Yeah.
All right. Want to go to plugs, Dean?
Yeah. Some shout outs this week. I'll be on Sales Chatter tomorrow morning at 9 a.m. Eastern with Dan Deegan and DJ Flores. Data Day Wednesday. You can connect with them on LinkedIn. I'll be on Landline Now tomorrow evening at 7 p.m. Eastern on Road Dog Radio Channel 146 on Sirius XM. And just to make a note, looking further down the road, Operation Safe Driver Week is scheduled for July 10 to 16. This is another safety blitz week where we'll see carriers sit it out. They generally do. We'll see what happens. But July 10, put that in your calendar, especially brokers, when you're thinking about capacity during that week.
Awesome. Jerome came in with a last-minute question. I'll just answer it real quick. He's asking about the direction of spot rates for Q3 and Q4. This year, again, our undisturbed stance as of right now is that rates will continue to be in this part of the cycle through the balance of the year. I do think you'll see seasonal pressure around Black Friday, but think about like the long-term trend. We're in this part of that long-term trend. It should start to bottom out. My guess would be February, March of next year when freight's typically slow. And then we should start to see upward pressures late in the first quarter next year, potentially. I think if we're going to be wrong, it'll be that that upward pressure doesn't happen until early Q2 of next year. So, again, we're constantly updating that thesis as more data comes in. It's obviously been a very volatile time, but we've been pretty steady in that over the last few months, just as like a long-term freight cycle perspective. All right, with that, I'm going to sign us off. It's still unclear, given the holiday next week, what the show's going to look like. So we may or may not see you, but we'll certainly catch up with you in a few weeks. If not, I hope everyone has a safe and relaxing Independence Day weekend, and we will see you the next time we see you. Bye, everyone.
Bye-bye.
Bye.